Good morning.
Welcome, everyone. We'll get started here in 1 minute. Hi, everybody. Welcome to today's session. I think in the interest of time and in the ethos of the title, Espresso Shot, What Nonprofits Need to Know About India's CSR Amendment, we will kick things off here. So my name is Michael Green. I'm the Director for Government Relations and Strategic Development at SONMS4, based out of our Washington, D.C. office. I work closely with a number of nonprofits on supporting their international market entry and governance issues. Prior to this, I was the general manager of our India operations based out of Mumbai. And prior to that, I actually worked for a nonprofit in Washington, DC. You'll see the title, again, this new format. This was inspired by Humentum, which SONMS4 is an industry partner of. They have their OPEX 365 going on an ongoing basis and essentially block off an hour and a half. So an hour focused on the substantive, and then if folks want to hang on post that hour, the speakers are available for that additional half hour. So in this case, we're going to try to pack all of the information into the first 30 minutes. My colleague Naoma will be leading us through that, and my other colleague, who I'll introduce shortly, Ed Dixon, will be leading the Q&A portion that will kind of be the second half hour. I do encourage everybody, as you have questions, to please drop them into the Q&A, use the Q&A button. That's what we'll be monitoring. I'll also be on chat as well, but I think it'll be easier for us to manage if those questions come through the Q&A button. So next slide. Just real quickly on SONMS4, we, for those not familiar with us, comprehensive and integrated market entry and expansion services and solutions firm, including tax, finance, accounting, payroll, and HR consulting expertise. We offer kind of an integrated professional services solution and support on both the advisory and the implementation side of things for our partners. In India alone, our clients or partners include leading international healthcare nonprofit organizations who partner with the Indian government and other organizations to promote healthcare outcomes, particularly in women and children, as well as some of the world's top research universities. Our team combines in-country expertise, Naoma here, as well as a global team of market entry professionals like myself and Ed to help organizations navigate the complexities of operating in new markets. Next slide, please. Leading us through today's session, I have Naoma, as I mentioned, and Ed. Naoma is based out of SONMS4's Delhi office and heads our tax and regulatory practice. She works directly on partners who are grappling with the complexities of doing business in India. She's a chartered accountant with prior experience with the Big Four in India. Ed here is our executive director based out of the UK in our London office. Prior to leading our UK and India and European based activity, Ed was our general manager based out of our Delhi office. He has significant experience supporting large and small organizations set up and scale up in markets across Asia, Africa, and the Americas. So in terms of what we have here today, I'll just provide a little bit of background. I think most of the folks who are joining us here today are familiar with the CSR Act in India, but I'll provide some some context and then turn it over to Naoma to go through the recent amendments. So next slide, please. Again, as many of you know, on April 1st, 2014, India became the first country to legally mandate corporates to spend 2% of their average net profits on corporate social responsibility. On the slide, you'll see kind of the qualifying measures for that. The law gave the basic framework around which CSR activities should be undertaken, the need for corporates to have a CSR policy, a CSR committee, implementation agencies, and under Section 7, there's a number of areas that the CSR can be spent on: hunger and poverty, education, health, gender equality, women empowerment, skills training, environment, social enterprise projects, and promotion of rural and national sport. Year on year, the scope of CSR activities has widened, and additional activities have found place in Schedule 7 that outlines these activities. The CSR framework has taken its shape through various amendments over the last few years, which Naoma can kind of touch on, and then, of course, cover the most recent ones. This year, the government has come up with some significant amendments by notifying amendments to Section 135 and amending CSR rules, which we will cover in this presentation. Next slide, please. A little bit of more kind of context in terms of the CSR space. Between 2014 and 2019, over 29,000 companies spent nearly 11 billion US dollars on CSR initiatives. About 9% of the total CSR projects are implemented in collaboration with government entities. 52% of the companies prefer routing their CSR money through setting up their own foundations. So many of you will be familiar with Tata Trust, and there's SBI, Jubilant, Emphasis, Kotak, prefer the foundation route. Usually companies with substantial funds prefer to set up their own foundations in order to have control over how the CSR money is spent. So I think, with that's a basic kind of frame. Naoma, you tasked me with 7 minutes, and I think I'll pass the baton over to you now. So next slide, please. Naoma.
Sorry. Thanks, Michael, and good morning, everyone. Thank you for joining us today. So here what we're going to be discussing are the key amendments that were introduced in the recently notified company CSR policy amendments rules 2021. So these rules amend the earlier rules which came out when Section 135 was notified. They were called company CSR policy rules 2014. These rules have come into effect on 22nd January 2021. Most of the provisions have come into effect, except one provision, which is to do with the registration requirement, which I'll take you through. And going through all the amendments that have happened, it seems the basic objective of these amendments is to boost transparency, because the number of the way the reporting happened in the board report and the way the registrations are now required by nonprofits, it seems that the idea is to boost transparency, which has been in the case in other regulations as well. It's for better governance. There's more reporting. The board has been given the task to look at the CSR more closely. There are penal implications which have also come into effect now. And more focused spending. They've asked for a proper action plan to be in place when the year starts, and also they have allowed a lot of provisions relating to promoting capacity building of the personnel who are actually engaged in the CSR. So moving to the next slide. So to start with, there are some minor changes in the implementing agencies, that's what we call it. So if a corporate has to undertake CSR, these are the list of avenues or list of implementing agencies through whom they can actually perform it. The first is they can directly do it. A corporate could always do it directly, and that still continues now. The second one, which was more or less there earlier, Section 8 trust society with a 3-year the third one, which is there, the Section 8 or a trust or a society with a 3-year track record, that continues. The only addition which has happened now is that the Section 8 trust or a non-profit should have the tax exemption registrations, which is known as 12A. That's to exempt the non-profits income, and ATG, which allows deduction to the donor. So now they've made it mandatory for the implementing agency, the third-party implementing agency, to have tax exemptions. They put it in the rules now, but more or less most corporates sort of followed it, and they always ask the non-profits to provide the tax exemption certificate. The second one is what was there earlier as well, which was introduced, I think, a few years back, is that corporates are now allowed to incur all their CSR through their own corporate foundations. They can make the corporate foundations themselves, or they can make it along with other companies. So a lot of corporates, as Michael mentioned, especially the big spenders, prefer to kind of put that money in their own foundation and then let the foundation handle how they want to spend it. So here also the requirement of such foundation to have a tax exemption has been introduced. Another change here is the change in the trust. So now they've clarified that it has to be a registered public trust. Earlier it was a registered trust or a registered charitable trust. The difference here is that they sort of clarified that the trust in which you give money to should be for the benefit of public at large. It should not be a trust which has been incorporated for a benefit of a small group of people. Apart from that, any entity that is established under an act of parliament or state legislature, and a Section 8 or a trust or a society which has been established by the central government or state government. It's interesting to note here that the requirement of the government trust non-profit to have a tax exemptions in place or have a 3-year track record is not there. So effectively, a government can just make a new non-profit, and that non-profit is eligible to receive CSR from day one. Going to the next slide. So there has been change in the definition of what CSR is. It's more or less just outlines what is excluded, just for clarification purposes. A lot of the changes that are here have actually happened or were already there. So there is not much new, or there's no sort of a change which has happened which we weren't expecting, you can say. So now CSR is defined as activities pursuant to Section 135. That's the section under Companies Act that talks about CSR. And what is excluded is activities that an organization undertakes in the normal course of business. If the normal course of business is, let's say, a company is undertaking activities which is in wastewater, it will not qualify as CSR because that's their main business of operations. An exception which has been made, which happened some time back as well, is that companies that are engaged in research and development for COVID-19 vaccine, drugs, or medical devices, there is a 3-year exemption sort of which has been given, 2021, 21-22, and 22-23. So in these 3 years, if these companies spend money on creating the vaccine or the drugs or the medical devices, that expenditure will be counted as CSR. But there is a catch to it. This is only going to be allowed if the collaboration is through institutes or organizations that are laid down in Schedule 7 in item 9, which is the IITs of India, and there's a long list of institutes mentioned there which are eligible to receive CSR, and the details need to be disclosed in the annual board report. Another activity which is not covered under CSR is if any company is undertaking activity outside India. Even under the Income Tax Act, it's very clear that whatever expenditure a non-profit does, it has to be applied in India. From the same thought process, this has been included now, that any activity that the company is doing outside India will not qualify as CSR. It's something which was there earlier as well. It's just now more clearly defined in the rules. An exception is the money that is spent on training of Indian sports people at state and India level, that are going and sort of participating at India level or at an international affair. Any direct or indirect contribution to any political party will not be considered. Any activity that benefits employees, this was there earlier as well, that any activities that benefit employees of the company will not qualify. Of course, this has to be seen in a way that if, let's say, there's an activity which is being done which sort of benefits the area in that the people in the area where CSR initiative is happening and there are employees there, it's absolutely fine. It's just that it should not be a targeted activity that only benefits a set of employees or the employees of that corporate or that sector. Then sponsorships, which was not allowed earlier as well, for deriving marketing benefits, and any statutory obligation which is there. Going to the next slide. So here are the other key amendments. The first one, which is there was a recommendation of it. It was something which we were expecting to come out, and now it is formally being introduced, is registration of the implementing agencies. So basically, non-profits, whether it's the corporate foundation or it's a third-party non-profit, all non-profits now, effective 1st April 2021, would need to file a form on the MCA portal and obtain a CSR registration number. The format of the form is already out, although the e-form, the fillable form, is not out yet. The form needs to be certified by a practicing chartered accountant or a CS or a CW. So, and the moment you file it, as of now, what is understood is that the number will be generated automatically. So it's not an approval-based process. It's also clarified in the rules that projects that are already approved the funding can go the way it was going, even if the nonprofit does not have the registration. But effective 1st April 2021, all projects will have to be given to only the nonprofits, whether corporate foundations, government foundations, or third party, that have the CSR registration number. As of now, we don't know how this data is going to appear, whether the income tax registration number, which has to be uploaded by the nonprofits, whether those details will be freely available to public, or it will be sort of hidden. But that is yet to be seen. But this is a sort of a way of collecting data of all nonprofits that are actually interested or are working with corporates on CSR related projects. The second amendment, which was there, it was earlier as well, the cap, the 5% of total is on administrative overheads. It's now been defined. Administrative overheads has been defined as general management or administration of CSR functions. The definition is definitely broader than the way it is in the FCRA. It's just general management. It can cover anything and everything. It's for us to decide what will be what will be included and what will not be there. The FCRA definition is a bit more clearer. The cap is 5% of total CSR expenditure. So it's not on the CSR money which has been put aside, which has to be spent. It's 5% of the actual expenditure, which that's the limit which has been there. And it's also been clarified that this does not include expenses that are directly incurred for designing, implementation, monitoring, and evaluation of a particular CSR project. So if it's the cost of a CSR personnel whose job is to hire project-related staff, then that would be administrative expenses. But if it's let's say an HR person who is just looking at managing a particular project, then we can say that the idea is for monitoring and filling the gaps in, and that should not be an administrative expenditure. Since the limit is 5%, there is going to be a lot of deliberation on what should be covered or not. FCRA allows a 20%. They brought it down from 50 to 20. So, but there's still enough room to ensure that all the administrative expenses are covered. 5% is a bit stringent. And there are certain types of project where administrative overheads might just be more, but it's good to see that the government clarified that any direct implementation, monitoring, evaluation expense will not be considered as administrative. Next slide, please. So there are a few inclusions in the rules relating to the CSR expenditure. First one was that it's been clarified that companies can incur CSR expenditure in collaboration with other entities. What they've said is that the CSR committee should be able to identify and report to the board and report to the respective boards about how the project is going and how the money is being spent. If that mechanism is in place, companies can collaborate. Even if they've not made a foundation, they can directly collaborate and do projects together. Any surplus which can arise, let's say there's a company that has organized a vision testing program, and they charge 2 rupees to everyone who's coming in. And Joyce, can you please go back? Thanks. So if they're charging, so that's sort of a surplus that is arising out of CSR activities. So it's been clarified that any surplus that arises out of these projects should be plowed back into that particular project. It is not going to be considered as business profits. What it means is that it will not be taxable. So it can either be plowed back into the same project, or it has to be transferred into the unspent CSR account, which was an account which was clarified that at the end of the year, if there is money earmarked for a certain project and that money has not been spent, then within 30 days of the end of the financial year, that money had to be deposited in the unspent CSR account in the bank. Now it's been clarified that any surplus should also be deposited there, or it should be deposited in the in any of the funds that are specified under Schedule 7, which is the PM Cares Fund, the Ganga Fund, etc. This needs the money needs to be deposited within 6 months from the expiry of the financial year. Any excess CSR spend, as was mentioned in the earlier slides, there are enough corporates that are spending over and above their required mandated 2%. So if corporates are spending over and above their mandated 2%, it's been clarified that they can set it off against the mandated CSR expenditure in the next preceding 3 years. So if you spend more on 1 year, you can take the benefit and you have the option of spending lesser in the other. It's also been clarified that if there's any surplus which is being generated, the excess is not about the surplus. That's not what we're talking about. It's just that excess expenditure which has been incurred. Next slide, please. So another point which has been clarified is sort of creation and acquisition of capital assets. A lot of CSR money which goes in is actually is used to build capital assets. It could be in the form of vans, immovable asset, or movable assets. Earlier there was no clarification around it, but now it's been clarified that if any asset is being created, such asset should be in the name of a non-profit, a third-party non-profit which is registered and with the MCA, or it should be in the name of the self-help groups or the collectives or the entities which sort of are the beneficiaries of the CSR project which resulted in the creation of the asset, or it should be in the name of a public authority as it is defined under the RTI Act. So it has to be transferred. And it's also been clarified that any assets that which are already in existence, the companies need to make the necessary arrangements to transfer these assets to any of the above 3 entities within a period of 180 days. A further extension of 90 days can also be taken from the board, but with reasonable justification given why you could not transfer it within 180 days. Going to the next slide. Yeah, so another addition is the requirement for impact assessment. This shows the intent of not treating CSR as just a frivolous one-off donation that you do and you get over with it. The government wants the corporates to take interest in understanding how the CSR money which has been spent, how it has impacted, and how it has benefited the community at large. So what has been clarified is that any company that has average CSR spend of over $1.4 million over 3 years, the average is $1.4 million. The requirement of getting impact assessment will be applicable on them. They need to get the projects which had outlays of over $140,000 to be assessed, and they got over at least 1 year before the day that you start the impact study. And the information regarding the impact study has to be included in the new format of the annual return, the annual CSR report that has to go in the board report. The information has to go there, and the impact study also has to be annexed to the annual report. The expense which is done on the impact study should not exceed 5% of the total CSR expenditure of the financial year in which the study happens, or $70,000, whichever is lesser. So there's a cap that maximum you can spend on the impact studies is $70,000. Although we discuss it later, another important point here is that it's been added that you can get these impact assessment done through international organizations, which are the various UN agencies which are notified by the government. You can approach them to get these impact assessments done. Going to the next slide. Other amendments which are there is that earlier only the CSR policy needed to be uploaded on the website. Now it's become mandatory for mentioning on your website who the members of the CSR committee are, apart from the CSR policy, and what are the projects that the company is doing. International organizations, which is UN and WHO and the rest, they can be hired for designing and monitoring and evaluation of the CSR projects, and they can also be hired to build the capacity of the CSR personnel. It could be in the foundations, it could be in the company itself, but now you can engage and you can leverage the knowledge and the expertise of these people in capacity building of your CSR personnel. CSR committee also needs to formulate and recommend an annual action plan. So this is something which was not there earlier. Earlier, the CSR committee had to make the CSR policy, and that was one of the requirements. Now at the start of the year, it's now CSR committee is also required to make an annual action plan. It should mention the list of CSR projects and programs that are approved, the manner in which these projects will be executed, the modalities of utilization, implementation schedules, monitoring, reporting mechanism, and details of need and impact assessment. So there has to be a comprehensive plan in place, which the CSR committee has to place before the board and have it approved that it has to be a very well-planned exercise and a thought and a well thought through exercise, rather than just deciding in Feb that we want to give X amount to this particular nonprofit. Another thing which you notice throughout the rules is that now there's a lot of onus on the board of directors, how the money is being utilized, if there has to be any change in the implementation plan, approvals of projects, whether there's any delay, how the unspent money has to be deposited into the accounts. There's a lot of onus which has been put on board of directors. Another clarification which is there is that the duration of projects, when you read the rules, there's the ongoing projects have been defined as projects that don't extend more than 3 years. So one interpretation is that only projects which have a maximum span of 3 years will be allowed under CSR now. This is something which is interpretation based. Hopefully in due course that there would be clarifications around it. Next slide, please. Another addition is that how the money is utilized has to be certified by the chief financial officer of the company, or whoever is the person responsible for the financial management. Although there is a need for certification, what happens to the certification, whether it just needs to be placed before the board, it just seems it just has to be placed before the board. There is no need for the certification to be uploaded anywhere. The new annual format of CSR activities, which is more comprehensive, there is more details required to be filled in. And so the new format, which has been a part of the rules which came out, it's applicable from 2021 onwards. So effectively, this financial year now, when we go ahead and file the returns, the 2021's financials and the board report will need to have the new format. It's not for 21-22 onwards. It's just a clarification there. And the definition of the net profit to calculate the CSR spend, it's been clarified that it does not include profits of overseas branch or branches, whether they are operated as a separate company or not, and dividend from other companies in India which are covered under with complying CSR, which are covered under, or if you get dividend from corporates that are already covered under the CSR mandate. So if you get dividend from a corporate which is not under CSR mandate, it will be included. If it's only from a corporate that is already basically involved in CSR, then you don't need to add it to your net profit. Next slide, please. So here, up till now, we've covered all the changes that happened in the new amended rules. On the same day, so both the Houses of Parliament on 22nd September 2020 passed the Companies Amendment Act, which effectively amended 66 sections of the Act. And the Amendment Act got presidential assent on 28th September. Over the months, different sections have been notified, and on the same day as the rules got notified, certain changes happened which are CSR related, which we thought is relevant for this webinar as well. First is a relaxation of constitution of the CSR committee. So in case companies have the obligation is less than 5 million INR, which is $70,000, they do not need to have a separate CSR committee anymore. It's the board of directors that are responsible for undertaking all the CSR related compliances. Another addition is the penal implications. Up till now, there was no penal implication on any entity that did not comply with the CSR provisions. They had to disclose the reason why they did not spend it, but there was no penalty which was imposed. Now, this we knew that as the CSR provisions mature and as they are accepted by the corporate world, there would be penalty implications to ensure that the corporates abide by it, and they don't kind of let it lie and just disclose it, especially smaller corporates, where the board is closely held by a small group of people, that year on year you sort of justify why you didn't spend it and just go on with it. Now they've put penalty implications in. So the penalty is twice the amount that was required to be transferred, amount to be spent or transferred, or 140,000, whichever is lesser. Also, apart from the company being penalized, even every officer of the company who is in default can also be penalized. So smaller organizations that only have basically a small group of board, this can impact them, because it might just become very difficult for them to prove that if there are two directors, then how come both the directors were not officers in default. So this puts that sort of stick on all the corporates to actually comply with the CSR provisions. So I think with this, I have finished all the amendments, and I hope I was able to explain it clearly to you. And over to Ed.
Great. Well done, Naima, making the complex simple. So having said that, we've got a few questions, and thanks to those of you that have posted questions and comments. To those that haven't, if you'd like to, please use the Q&A function, and we'll dive into those questions. I've got a few myself as well, so let's just dive into those. And I'm just going to paraphrase the first of the questions, which is around the admin cap. So I think the question was really trying to seek clarity on whether the admin cap applies to the corporate that's essentially spending the percentage of their profit, or whether it applies to the implementing agency, I suppose in this case a non-profit. So can you just elaborate there?
So good point. I think we still we have to sort of evaluate how this is going to be interpreted. But my initial reaction to it is that this means 5% of so the corporate foundation or the corporate should not spend 5% or more. But this is something which we'll have to look at in a little more detail to confirm.
Excellent. Okay, and I guess there's a supplementary point there, which we don't need to answer here, but is whether that is then per project or as a total. Which anyway, I won't impose that question on you now. The second one then is around the costs associated for capacity building, and whether there's a cap on that as it relates to capacity building of personnel.
So capacity building will also form the 5% within the 5% limit. It
Okay.
will be treated as an indirect expense. It has been clarified that any impact assessment, etc., which you do, that is direct. So capacity building of personnel will be treated as indirect.
And the third one is more a comment, but I might just sort of twist it into a question, which is, as it relates to the annual planning requirement. So clearly there's a requirement for boards to be more deliberate about how they're spending this money. And so the question is really whether that might have a negative effect on some non-profits, in as much as organizations might commit then to spending money with the same sort of recipients, and that then starts to roll over year on year. And therefore it maybe reduces flexibility for individual non-profits to approach those organizations. Do you have any thoughts on that?
Yes, absolutely. This can be the case that corporates sort of prefer to go with the same non-profit, because at the start of the year, when they want to quickly close the requirements, etc., of having an annual plan in place, it's easy just to sort of Control-C, Control-V from the previous year and say that let's just continue spending the same on the same project. And actually, we've seen the same thing even currently. A lot of non-profits which have a smaller CSR spend, they don't want to spend time or actually go into the market and find new projects. They decide to give the money to a certain non-profit and for a certain project, and they give it to them year on year. So yes, I think the reason why there has been allowing of CSR spend on capacity building, etc., is to kind of enable that attitude that don't go out, have a better understanding of the projects, have a better understanding of what that impact is, take that interest, and hopefully that will create that stir that let's actually do good rather than just do the compliance.
Okay, great. So some longer term planning requirements. Let's move on to another question which I had, which was obviously there were changes expected. Are there things that you expected to come through in this latest set of changes which haven't materialized and therefore still sit out there as open questions?
So not in the Companies Act, but definitely in the tax laws. It's important that you sort of when money is being given to non-profits, which then the donor only gets 50% deduction, and it's not even considered as a allowable expense under Income Tax Act. While if money is given to, let's say, PM Cares Fund or the government or the Ganga Fund, then the corporate can claim 100% deduction. So this, in a way, tilts the CSR spend in favor of government, and doesn't because end of the day, corporates need to make profit, and if they can save tax by giving money to PM Cares Fund, they are going to choose PM Cares Fund. Although a lot of non-profits do not do that, but so we were expecting that in this budget, especially because of COVID, there would be a change that when you give money under CSR, you can claim it as an expenditure, irrespective of whether that entity has an ATG registration or not. Otherwise, there is a clear bias that when you give money to the government, you get 100% deduction. And another clarification which would have been good to have is that the applicability of GST. The definition of charitable activities under GST is fairly narrow. It's not the same as Income Tax Act, and there's a constant debate happening whether money which, when given to non-profits, whether GST is applicable to it or not. Because if you give it for a certain specific activities, only those activities are covered, are outside GST. So it would have been good had the government clarified this point, whether donations given to non-profits will be outside the ambit of GST. So these are the two amendments which we were hoping would be there in the budget, which weren't.
Okay, all right, maybe sit tight for future changes. So a couple of other questions then. So and this is a scenario, when a project is planned for, say, 3 years, can the disbursement to the NGO be done in advance for years 2 and 3, such that it can kind of help fast track those projects and presumably also help meet their spending requirements against the 2% profits?
Yes, so funds can be given. For it's not necessary that the funding that goes from the corporate should only be for the 1 year in whatever activities a nonprofit will do in that specific year for that project. It can be given the funds, the funding can be transferred, and of course it is a responsibility of the corporate to keep monitoring the progress of that project.
So the cash can move in year one, years 2 and 3. Yeah. Okay. Okay, a subsequent question then. So can you talk about the correlation between CSR and FCRA, and specifically why is this a requirement for certain companies if CSR is 2% of profits of the Indian entity and not of foreign entities?
So actually, legally, there is no correlation between CSR and FCRA. CSR doesn't, in fact, to allow, so earlier the FCRA regulation said that a subsidiary of a foreign company, if that Indian subsidiary gave a grant, that would be covered under FCRA. It would count as foreign contribution. In fact, that specific exemption came into place to allow like foreign subsidiaries to go ahead and give money to any non-profit, and the definition of foreign source under FCRA was changed to allow it. So legally there is no correlation, but practically there are some non-profits which ask for it, that whether the entity is FCRA registered or not. I think it's even before the requirement of 12A ATG registration was put in the rules, a lot of donors did ask the non-profit whether they had the 12A and ATG registration or not. I think it was in a way of ensuring whether the entities are sort of compliant. And because the moment you know that the entity is 12A ATG registered or is FCRA registered, there is a scanning which has already happened of the non-profit, because FCRA registration means that every board member, everyone has been scanned, and there's been so that initial check has been done. So I think the need for FCRA doesn't flow from any law. It's just it just gives added comfort to the corporate to ensure that there is no red flag in that non-profit.
Great. Okay, well explained. Just, I suppose, building on that a little bit, and in the context of, I guess, the direction that FCRA is taking the non-profit sector in, and the fact that some non-profits are moving into a for-profit structure, perhaps you can also just make some comments about the roles of for-profit entities in this sort of ecosystem and in this context.
So if a corporate is undertaking a CSR project directly, of course, everything they cannot do in-house. So a lot of work can be outsourced, or funding can go from the corporate to the for-profit. Similarly, if there's a non-profit which is undertaking a project and they need support, for-profit entities can collaborate with them as vendors. So in this entire ecosystem, and that's what happens currently as well, for-profit entities are sort of support entities or vendors to the implementing agency or the corporate that is undertaking the project.
Great. So what about in-flight CSR projects that would no longer, I guess, qualify under the amended rules? Would those need to be ceased, or what happens?
So the definition of CSR activities that are covered has not changed. So effectively, all projects which were earlier also being undertaken, they are fine. It's just that going forward, those projects cannot be undertaken through a non-profit that doesn't have the tax registrations and doesn't have the registration with ROC. But it's been clarified that any project that is already approved before 1st April 2021, those are good to go. They will not be impacted. They can be, in fact, undertaken through the non-profit which doesn't have the 12A ATG or is not registered with the registrar of companies.
Okay, so just to clarify on that then, so will a non-profit not be able to receive funding from the 1st of April unless they've been registered with the registrar of companies?
Yes, 1st of April, or any new projects or which are approved by the corporate, those projects can only be undertaken through a non-profit that is registered with the registrar of companies.
Okay, therefore the kind of importance of this e-form becomes that much more important. Any any expectation in terms of a timeline for that to come out?
So the e-form should come out before 1st of April. Hopefully the government is going to give a month or two, a month at least, for nonprofits to kind of submit this document in. But I think because we're already sitting in mid-Feb, there are chances that they'll sort of extend the deadline and give some more time to nonprofits to apply for it.
Okay, great. I'm just going to loop Michael in because it looks like he's got a question. Michael?
Yeah, sure. Thanks, Ed. I just want to loop back on Bharti's question about kind of the role of the for-profit entity in this ecosystem. And I think, Naoma, you mentioned kind of the role from the pure CSR perspective, but I think for the folks that have dialed in, the for-profit entity is also a way to be able to kind of bring monies from overseas into India. So can you speak, I guess, a little bit, kind of to that and how that kind of structure works in the broader context of having a dual structure, and I guess the pros and cons of that?
So purely speaking from a CSR perspective, obviously there is the foreign grants that come in are not mixed in a way. It's just that a for-profit entity, which anyways cannot receive foreign grants, can in a way attach themselves to implementing agencies in India and continue working in India and supporting. So let's say there's an organization which is into research, they can they can undertake those activities as a for-profit service, and they can provide that commercial research service to a non-profit that is maybe looking at a larger piece of project. Obviously, it cannot be that $100 move from the corporate entity to the implementing agency and 99 moves to the vendor or the for-profit arm. It has to make sense that why was the non-profit chosen as the CSR partner? What is it that non-profit is actually contributing? And then as a part of it, a certain percentage can then move to the for-profit entity, and you can work out of there. So the entire idea of an international nonprofit having a dual structure is that in the for-profit entity, you can work on projects and get funding from overseas, which might not be possible on day one. And the not-for-profit entity down the line, hopefully, if you get the FCRA registration, will allow you to directly receive money from overseas. But even if that doesn't happen, or in the interim, you can at least, after establishing the 3-year track record, you can actually go and start getting CSR money. Interestingly, there is no clarification which is there that corporate foundations can only give sub-grants to non-profits that have a 3-year track record. A lot of foundations do follow it, but it's not under law. So let's say an IBM foundation on day one can also give it to a newly incorporated nonprofit, and the newly incorporated nonprofit can then provide that support to the foundation. So effectively, the corporate has met its requirement of transferring money to the foundation, and the foundation then is free to give sub-grants to whichever nonprofit it wants, whether it has a 3-year track record or not, to undertake projects. This is theoretical, but practically, a lot of foundations ask nonprofits to have a 3-year track record.
That's great. Good.
Yeah, I was just going to add to that. I think back to the point, and I think the trend that's happening here with a lot of these amendments, I think that the corporates are going to become increasingly conservative in terms of how they approach this space. So expecting organizations, even though it's not a legal requirement to have FCRA approval, they're probably going to kind of err on the side of, wanting the 3-year track record, and then even potentially wanting the FCRA kind of approval before they give.
Yes, absolutely. But at the same time, Michael, if you see the big spenders like ONGC, which have their checklist on their website, they don't ask for it, and because they don't consider it as a prerequisite. But of course, you're right in pointing out that corporates are going to be a bit more careful and will scrutinize the nonprofits that to whom they give the money. Of course, the FCRA is a point which can be argued. I believe if you put the law in front of them, unless and until it's a board that does not want to move, whether it's legal or not. But if you can clarify to them, and you can give a legal opinion that it's not applicable, so there's no need for you to ask for it effectively, because you're sort of culling out, or just ensuring that the grassroots nonprofits or smaller nonprofits who never really thought of going and bringing foreign money to do their operations, those all nonprofits will starve if the condition is that unless and until you have an FCRA registration, you will not get the money. Because the idea of CSR was always to also do capacity building in grassroots level nonprofits, because those are the guys who are actually in the remote villages and who are doing the work. Effectively, now FCRA has said that you cannot give sub grants. So anyways, those smaller NGOs are going to be starved for funds. So if corporates go ahead and put the condition that unless those smaller NGOs have FCRA registration, they will not get the funds, they have nowhere to get funds from then. They're only left at the mercy of philanthropists and individuals who will just come and give them some money. Otherwise, even the CSR route is stopped for them.
Yeah. Great points. A few more questions then. So if we go back to the earlier question about, I suppose, multi-year engagements, what happens if you've got projects that span more than 3 years? Are there any constraints?
So just reading the law right now, it seems that only projects that have a 3-year outlay will be considered as CSR projects. If it's a project that is spanning like more than 3 years, then I think the nonprofits or the CSR implementing agency will have to break it down into smaller projects and show it as different projects to get funding in. It can't be a 10-year commitment.
Okay, great. And then switching tack a little bit. So will funds with the implementing agency that haven't been spent be termed as unspent?
No, if the money has been given to the implementing agency, the corporate is good. It's only if they don't end up giving the money.
Okay, great. And then one final one from me, which relates to the management body of the implementing agency. So are there any kind of penal implications on those bodies in the context of this area of law?
Not yet. Right now, it's just limited to the directors. So the first step was to get the company and the directors in line. So there is the newly introduced penal implications is only on the company and the directors. It doesn't go down to the implementing agency yet.
Okay, sounds like possibly watch this space. Good. Well, that's been a healthy 20 odd minutes of questions. So thanks again, Naima, to taking those on the fly, and thanks for the insights. I should also thank all of you that have asked good questions, because it helps tease out the reality of where people's thinking is and where clarifications are required. So if there are no other questions, what I'll do is thank both Michael and Naima in particular for all her hard work here today. And look, thanks to all of you for tuning in today. I hope you've had your shot of espresso caffeine or decaffeinated, whichever you prefer. And this has been a helpful session. So thanks to all of you, and until next time.
Thank you so much.